Hello and welcome to today's webinar on buying first trust deed notes. My name is Ryan Dodge with Silverstream Advisors. Really excited to be talking with you about this today. Before we start, hello and welcome to today's webinar. My name is Ryan Dodge with Silverstream Advisors. Today we're going to be talking about buying first trust deed notes, and why I'm so excited about this and why I think it's such a great opportunity for today's market as an alternative investment, and we think it's perfect for the market that we're in today. Let's go ahead and get started and talk a little bit about why trust deed notes. Why are we even talking about this? And so a little bit of my background. I've been in financial services for 14 years now. And one of the things I learned early on is that there are certain things that banks are out there doing all the time. There are things that banks do with their money. Obviously, they do a lot of lending. They hold your money, but they also do a lot of lending to other people, and even back to you with some of your own money. But one of the types of assets that banks have always owned is real estate, mortgages on real estate, on real property. And the question always needs to be asked, banks are some of the most successful financial institutions out there, banks and insurance companies. So we mentioned banks on here, but actually insurance companies are very similar to banks in that they own a whole lot of real estate in the form of mortgages and actual deeded property in some cases, commercial property. And you have to ask yourselves, if all the banks can own these types of assets, why can't I own them as well? And typically we're told, well, you can own something similar. Maybe you could invest in a mutual fund that invests heavily in real property, or you might even own a REIT that has real estate holdings. But at the end of the day, you have to ask yourself, why can't I own the notes myself directly? And the answer to that question, of course, is you can. There is nothing stopping you from holding those same types of assets that banks have held for as long as they've been around. So today's webinar, we're going to learn a little bit about what are these notes, how the notes that we're dealing with are different, why the opportunity is so great, how you are protected, and why clients should be afraid of traditional paper assets. And we'll talk a little bit more about what it means to own a paper asset versus a real or tangible asset. So let's go ahead and get started with talking about what are non-recourse first trust deed loans. Now, there are a couple of things up there that might be new terminology for you. Non-recourse for one, first trust deed loan, that might be something you haven't heard as well. So what that really is, in a nutshell, is it is a position, a liened position against real property, a liened first position, meaning you are the first person that gets paid back. And in this case, we're talking about non-recourse loans. So these are loans that, so typically when you go out and you get a mortgage, you go through this whole loan process, this qualification process. And after they've approved the loan, primary collateral on that loan is your home, and which means if you don't pay it, they might foreclose on that home. Secondary collateral on that is you as an individual, and they might come after you, depending on what state you live in and what the laws are. But there is typically some kind of recourse against you as an individual signing on that loan. Non-recourse first trust deed loans are loans where there is no recourse against the individual that is getting the loan. So the property itself is the only collateral. And we'll talk a little bit later about why that's not such a bad thing. So the properties we're dealing with at Silverstream are typically sold for 50% of the cost to rebuild. So if you're in a market and the cost to rebuild a brand new home is about $70 a square foot, Silverstream will probably be selling those homes for $35 a square foot, or even less in some cases. So that's, first of all, these are the types of homes that we're dealing with. Second is we're dealing, as I said before, in non-recourse debt. So it's secured only by the home itself. On top of the fact that the homes we're selling are 50% cost to rebuild, the loans themselves are only 50 to 60%, I'd say actually 50% or less actually, loan to value. So let's say you have a property that we are selling for $50,000. And that property, that $50,000 property is already worth substantially more than the $50,000. That $50,000 is only $35 a square foot. So its estimated value could be, $75,000, even $100,000. Well, the loan on that property is only going to be for $25,000. Again, 50% of the purchase price, not necessarily the value of the home. So in this case, if the home were valued at $100,000, that $25,000 loan would represent a 25% loan to value. So you can see how it could be substantially less than 50%. The reason we use non-recourse loans is because we deal with a lot of people that understand that you can use retirement money, so IRAs, for example, qualified money, to purchase real property. And that right there might be a new concept to you, but a lot of people are really starting to understand that IRAs and other retirement accounts can be used to buy real property, real estate. And since we deal a lot with people who have these IRAs, a lot of the loans we're dealing with also are non-recourse. And that's just a requirement of any type of qualified plan or retirement plan. If you are going to purchase property and have a loan against that property, that it needs to be non-recourse. If we're just talking about cash outside of a qualified plan, the loans themselves don't need to be non-recourse. Okay, so in that case, any entity or person can utilize the benefits of leverage using a non-recourse loan. So it doesn't matter, inside or out. Non-recourse loans have simple documents and tracking. If a foreclosure is needed, then a deed in lieu is recorded. Property becomes the lender's within 30 days with an assignment of rents. Okay, let's talk a little bit about what is a tangible asset. We're going to back up a little bit. What is a tangible asset? So in my mind, tangible assets are things that have a physical form. I can touch, taste, and I can smell them. They have some kind of intrinsic value, meaning they have value from an objective point of view. Most of the investments that we are used to dealing with are pretty much subjective in nature. They are up or down based on some very subjective things. I'll throw out an example of Apple. Apple's revenues year over year are always up, and yet their stock went as high as $700 a share, higher than $700 a share, and then all the way back to $500 a share. And I haven't checked it today to see where it's at. But a lot of that value was very subjective. It's just people having more and less confidence in a company that is really still doing the same it was the day before. I mean, everybody's familiar with the fact that the stock market goes up and down on a daily basis. Well, a lot of this is just very subjective in nature. So we're talking about tangible assets that have to have some kind of value outside of just what other people think. So value by its very nature. Another example of a tangible asset that a lot of people use is something like gold. It has some kind of intrinsic value. Now, there are a lot of subjective parts of gold, but it's always going to have some kind of intrinsic value because it's tangible. Okay, a promissory note, what is that? What that is that's just a contract for repayment on a capital purchase. So in this case, the real estate, the property. First trust deed is a recorded lien on that property that references the promissory note. First trust deed, as I said before, is a first position. You are first in line to get paid back. These are also properties that will not have a second position. There isn't anybody behind you. We just make sure that we say first trust deed so that people know you are first in line. A deed in lieu is something that a lien holder can do to take ownership of a property without going through a foreclosure process. So that's something that's usually agreed to in advance, but also when that foreclosure process becomes necessary to avoid having to go through that lengthy process of foreclosure. An assignment of rents, that just means any income on the liened property is assigned to the lien holder. Okay, why has note buying become popular, and why is it attractive right now? A lot of people are moving away from traditional investments, and I'd say the biggest reason that they're moving away from traditional investments is just a lot of uncertainty. uncertainty in the stock market. Now, I realized that a couple weeks ago we had 10 straight days of the Dow going up, and a lot of people gained a lot of confidence from that. Reality is that had very little to do with whether or not your particular investment was going up or down, and it really didn't take out a lot of that uncertainty that goes along with having that market. A lot of that increase in the Dow could simply become, didn't necessarily come from increased production as a country. It just came from the simple fact that more people had confidence in the stock market. We all woke up one morning and we said, you know what, I like the stock market today, and it goes up. I've always been a little bit uncomfortable with the fact that 300 million people could wake up one morning, be in a bad mood, and have it affect my investments. So that's a little bit of why people are turning to some of these more tangible assets. That, and I think we're becoming more savvy, more intelligent as a whole. We have more information available to us, and we realize some of these notes, as I mentioned before, are things that mortgages that banks have owned forever, and banks have always traditionally been some of the most successful financial institutions out there. Here's some of the trends. Here's some of the things that financial advisors are saying, saying that they plan to increase their use of alternative investments. Half of all financial advisors say they want to use more alternative investments. A lot of advisors are talking about wanting to diversify things, not just have things in the stock market. And a lot of people are talking about economic volatility. And I think some of the reality here is that financial advisors are realizing this is what their clients are asking for. At the end of the day, they want to sell a product that people are asking for, and this is something that people are asking for. Some of the things that we've typically thought of as being safe havens against losing money or losing a little bit of that status. Treasuries are certainly getting a bad name, and they're not going to get a better name as the debt increases and our deficit increases. With a loose money supply, some of these things can, gold in some ways can actually become stronger with a loose money supply. Treasuries are devalued. Gold, one of the reasons I've always, even though we talk about gold being a tangible asset, at the end of the day, real estate has more intrinsic value than even gold does. There is more value, there is more utility in that property than even in gold. I always use the example if, today somebody were to give you, let's just say gold was $1,600 an ounce again, which it's not, but let's just say it was at $1,600, and somebody gave me 100 ounces of gold in exchange for my house that's worth $160,000. And we made that transaction, we made that exchange, and everything was good. Let's say the economy got really bad. And I'm sitting here and I've got my 100 ounces of gold now that this guy gave me, and he's living in my house. And I'm thinking, you know what, I could really use a place to live. And I go back to him, and with the economy being as bad as it is, and nobody's producing anything of value, and I say, you know what, I'd like that house back. And he'd say, yeah, no problem, I'd love to sell it to you. What do you have? And I say, well, in exchange for that house, I'll give you this 100 ounces of gold. And he says, well, things are really bad, and it's really hard to get things. I won't do it for 100, but I'll do it for maybe 200 ounces of gold, because at the end of the day, I'm going to have to trade that gold to somebody else for something else that I value or I could really use today. And it's going to become very subjective at that point. And in that bad economy, my feeling is that real property is going to have more tangible value, intrinsic value, than even gold will. So here's some of the pros and cons of non-recourse loans. One of the pros, of course, is that you get higher than average returns, typically 8 to 12% per year. And this is 8% with something very tangible and real backing it. And these we've seen time and time again how stable these types of investments are. Now, you might ask yourself, why would somebody pay 8% for a loan on a property? Well, the reality is most of these properties that we're selling at Silverstream are generating 12 to 18% returns. And in a scenario like that, if they can get 8% on a portion of that, they're still generating a spread between what they pay you for the loan and what they're able to generate on the property. So it's still a positive scenario for them. They're able to leverage themselves into multiple properties. Another pro is that you have the safety of the investment principal secured by that first trust position. This is all done through the traditional means, done at title with recorded lien, recorded mortgage on the property, depending on what state you're in. Another pro is that you can sell your note for a quick profit. Some of these notes are going to have real value, tradable value that other people are going to recognize. One of the cons could be that you can't personally go after other assets other than the property pledged as collateral. Now, that can be seen as a con. It may also be a positive thing, meaning you get the property back in a much quicker fashion and you get moving on. A pro and a con, both, is that you have a fixed return year after year when it's performing. Another pro and con is that when it defaults, and when I say pro and con, all I mean is that it depends on your capacity to see a situation as an opportunity. If there's a default and you now own the property, you're going to have to manage it as if it's your own rental property and decide what to do with it. Now, why is that a pro and a con? Well, the positive is that if for some crazy reason somebody does default, you have this property, you've purchased this property at essentially 25% of its face value. You're in it for very little. So you have a lot of options at that point. So what is protecting your principal and your income? So what's collateralizing the loan? The property, a first trust deed on the property, 50% cash down. So those people have actually come to the table with 50% cash. Think about your own personal mortgage. Most people look at mortgages and they might put 10, 20% down. In this case, these people are putting 50% down. These properties are rental properties, so they have a tenant in them. This isn't somebody's vacation property that they're just using every once in a while and you're hoping that their income covers it. No, these are rental properties and they have tenants in them. So you have both the tenant and the property owner that are securing that payment. We've got a deed in lieu of foreclosure, assignment of rents in case of default, and then loss payee coverage with the insurance company. So I want to give you a little bit of an example, portfolio example of some of the properties we've dealt with in the past. These are some properties that we've sold. As you can see, the prices on these are between $40,000 and $50,000. So the financed amount down below is going to be about half of that. So kind of on the lower end of rental properties. But as you can see from the net operating income down there as well, these people are making a good amount of money on these. There's very, very low risk or low chance that people are going to be defaulting on these loans. These are just some more of the properties that we have out there as well. One or two of these, well, one here, this duplex, $78,000, does bump up the price a little bit, but as you can see, net operating income has also increased substantially, more than doubled on this particular one. So here at Silverstream, we have a tried and true method called the real estate money machine that is your blueprint for success. Our goal with you is to generate annual returns of between 10 and 20%. We have a low cost of entry, $30,000 to $100,000, even lower than $30,000 in many cases, as you saw from those properties. You might be coming into them for $20,000 to $25,000. All of these properties can be acquired with your IRA or solo 401k. So if you have qualified money already, this is something for you to be able to look at. Asset protected, tax advantage. So if it's an IRA, it already has the tax advantages. If it's not, if you're just purchasing real estate outside of an IRA, talk to your accountant about what the advantages are of owning real estate. Protected against inflation. Real estate has always been a great hedge against inflation. And again, what we're talking about here in all of our estimates, we're not speculating on the values of these homes going up from one day to the next or even going down. All of our projections are based on the rental income that you can get on those properties. And that rental income is very stable and is definitely increasing over time. This is also the type of investment that pays you dividends every month versus having to, I go back to gold. Gold doesn't pay a dividend. Gold only pays if you sell it at a future date. So it's completely speculative in nature. How are we going to measure success? Most successful real estate investors think and act differently. We like to use the 80-20 rule to compare these two groups. 80% of the real estate deals are done by 20% of all real estate investors. 20% are successful because they think and act differently. So what these people have are principles that they can rely on, proven strategies, and then products that have been vetted. And in this case, with an enormous amount of research to make sure that we're actually in a good product. Are we a good fit? If you'd like to get a hold of us, we'd love to hear from you. We'd love to talk to you about more of these ideas, both on the notes themselves or even just properties. So I appreciate your time and look forward to hearing from you.